The Fed meets on March 17th. Right now, most investors are doing one of two things. They are either completely frozen, waiting to see what happens, or they are quietly pulling money off the table, trying to avoid the volatility. Here is the hard truth. Both of those approaches will cost you money. The weeks right before a Federal Reserve meeting are historically some of the best buying windows of the full year. Markets reprice uncertainty. Stocks dip on fear. Then the announcement lands, and capital rushes back in fast. So today, I am not waiting around. I am walking you through 5 stocks I am actively buying right now before March 17th. Each one carries a different risk profile, but all 5 share one common thread. They win regardless of what the Fed decides on that date. Let me show you exactly why. Let us start with the setup, because understanding what is happening right now makes these 5 picks make far more sense. At the January 28th meeting, the Fed held interest rates steady at a target range of 3.5% to 3.75%. That was after 3 consecutive rate cuts in late 2025. Markets are currently pricing in another hold at the March 17th through 18th meeting, with the first potential cut not expected until June at the earliest. But here's where it gets more complicated, and this is what most coverage is missing. 2 Federal Reserve governors actually dissented at the January meeting, preferring an immediate quarter-point cut. That internal split is significant. It tells you the committee is genuinely divided on where rates should go right now. On top of that, Kevin Warsh was just nominated as the incoming Fed chair, replacing Jerome Powell, whose term ends in May. Warsh has historically leaned hawkish, meaning tighter policy preferences, not easier ones. If confirmed, that could signal a more restrictive direction for monetary policy going forward. Meanwhile, December's consumer price index came in at 2.7% year over year, still sitting above the Fed's 2% long-run target. And new tariff pressures could add anywhere from half a percentage point to a full percentage point more to inflation later in the year. The Fed has real reasons to stay patient. So what does all of this mean for your portfolio? It means uncertainty is elevated right now. Elevated uncertainty means that strong businesses are temporarily trading at short-term discounts. That discount is the exact window I am stepping into with these 5 picks. Before I walk you through each stock, let me explain how I am building this list. I am not betting on one specific Fed outcome. I am building a barbell portfolio. On one side, large-cap companies with strong balance sheets and locked-in revenue. These names compound in any rate environment. They do not need cuts to grow. On the other side, 2 infrastructure plays with explosive order books. Those carry specific upside leverage if rate cuts arrive in the second half. 3 of these 5 stocks are what I call rate agnostic. They are growing entirely on AI infrastructure demand. And that demand is not pausing for a Fed meeting. Hyperscalers like Amazon, Microsoft, and Google are expected to collectively spend $650 billion on AI investments in 2026 alone. That capital is already committed. The data center build-out is already in motion, and the companies I am about to show you are right in the middle of it. Stock number 1 is NVIDIA. If AI is the industrial revolution of this era, NVIDIA is building the steam engine, and they are not building it for one customer. They are building it for every data center on Earth. NVIDIA controls approximately 92% of the data center GPU market. That is not a temporary lead built on luck. Every new wave of AI development, from training large language models to real-time inference, requires more compute than the generation before it. And NVIDIA keeps releasing faster hardware that widens the gap over every competitor. The company previously reported a $500 billion backlog for its Blackwell and Rubin chips through fiscal year 2027. This year, NVIDIA is launching its next platform, the Vera Rubin AI Accelerator Series. All major cloud providers are already lined up to deploy it. Microsoft's next-generation AI data centers are among the first customers confirmed. Wall Street analysts are currently forecasting 57% earnings growth for NVIDIA in 2026. That growth is tied directly to hardware already contracted inside that backlog. Here is the reason I am comfortable buying NVIDIA right now, even with a Fed hold coming. Hyperscalers are not going to pause their AI build-out over one policy announcement. The spending is contracted. The demand is structural. It is not rate-sensitive. JP Morgan projects AI infrastructure capital expenditure will reach $1.4 trillion annually by 2030. NVIDIA is the primary beneficiary of every dollar inside that projection. It dominates the chip, but chips are useless if the data cannot move fast enough. That brings us to stock number 2, Arista Networks. Most people watching this video have never heard of Arista.
It manufactures high-performance networking switches that connect GPU clusters inside data centers. Think about what that actually means. You can pack 10,000 NVIDIA GPUs into a single facility, but if the switches connecting them cannot move data fast enough, your entire cluster slows to a crawl. Every AI cluster on Earth depends on the pipes connecting those chips. Arista makes the best pipes in the business. Here is the upgrade cycle driving that growth. Data center networking speeds are doubling right now, moving from 800 gigabits per second toward 1.6 terabits per second. Every new GPU generation produces more data. Without faster switches, clusters choke. Arista manufactures exactly those switches. The company recently reported market-beating fourth quarter 2025 results and issued strong expectations for 2026. Its gross margins are consistently holding above 60%. What I also like about Arista is the software layer. Their operating system, EOS, gives cloud providers the flexibility to scale networks without being locked into closed proprietary systems. That software creates sticky, recurring revenue stacked on top of the hardware sales. Arista is smaller than NVIDIA, but inside the data center, just as indispensable. So the pipes are covered. Now, let us talk about the company that owns the building, the cloud, and half the internet's shopping cart. That leads us to stock number 3.
It's Amazon. Here's something that might surprise you. Amazon was actually one of the weakest performers among large-cap tech in 2025. The stock rose only about 5% for the full year, massively underperforming every one of its big tech peers. That underperformance has created a relative discount in a genuinely dominant business, and that discount is exactly why I am buying it now. Amazon Web Services holds approximately 30% of the global cloud market, more than Microsoft Azure and Google Cloud combined. And that business is accelerating. As enterprises deploy more AI workloads, they need more cloud compute. AWS is where the majority of those workloads land. Revenue growth in that division is picking back up quarter over quarter. Amazon now generates over $68 billion annually in advertising revenue alone. That ad business is growing faster than Google's core search advertising. When consumers are ready to buy something, more than half of US shoppers start their product search on Amazon, not Google. Advertisers follow intent. The dollars follow the buyers. Amazon is also designing its own AI chips, Trainium for training, Inferentia for inference. These chips cut infrastructure costs while locking enterprise customers deeper into the AWS ecosystem. And then there is Project Kuiper. Amazon is building a satellite broadband constellation that will exceed 3,000 satellites by the end of this decade. Early test runs have already hit 1 gigabit per second speeds. Government and airline contracts are already signed. Amazon is not one business. It is 5 separate businesses compounding simultaneously. Right now, the market is only really pricing in one of them. That gap is the opportunity. Now, 5 businesses are compounding under one roof. But every single one of those businesses, and every data center running them, needs one thing above everything else: power and cooling. That is stock number 4, Vertiv Holdings. Let me give you the thesis in exactly one sentence. Every NVIDIA GPU needs electricity. Every server rack needs cooling. Without power management and thermal systems, no AI data center stays online. Vertiv makes both. Now, let me give you the number that made me add this stock to my list. Vertiv reported that organic orders surged 252% in the fourth quarter of 2025. That is what actual AI infrastructure build-out demand looks like in real numbers. Bank of America analyst Andrew Obin reiterated a buy rating following that report and raised his price target to $277. He projected Vertiv's 2026 orders to reach $18.6 billion, on top of the $17.8 billion already recorded in 2025. He specifically noted that the order pipeline was not depleted after the record fourth quarter. Here is what makes Vertiv particularly compelling as a holding right now. It does not matter which chip company wins the GPU arms race. Whether the dominant AI chip comes from NVIDIA, Broadcom, or AMD, every one of those chips needs power and cooling. Vertiv wins regardless of who wins. And speaking of the chip war, there is a second lane being built right now that almost nobody is watching. Everyone knows NVIDIA. Almost nobody is watching the chip company that Google and Meta are quietly depending on to reduce their NVIDIA exposure. That company is Broadcom. Broadcom designs custom ASICs, specifically for hyperscalers like Google and Meta platforms. Unlike general-purpose GPUs, these chips are engineered from the ground up for each customer's specific workload. For large-scale inference tasks specifically, custom ASICs can deliver meaningfully better cost efficiency than off-the-shelf GPUs. As hyperscalers scale their clusters from hundreds to tens of thousands of chips, cost per chip efficiency matters more and more. Goldman Sachs analyst James Schneider set a price target of $450 on Broadcom, highlighting its unique dominance in custom silicon design and citing expanding relationships with Anthropic and OpenAI as additional upside drivers. Broadcom shares have risen more than 50% recently, and the company carries a market capitalization of approximately $1.6 trillion. I am still adding at this valuation. Here is why. Hyperscalers are spending $650 billion on AI this year alone. At that scale of spending, they cannot afford to be entirely dependent on any single chip supplier. Broadcom is the second lane they are actively building right now, and they are building it fast.
Now, let me put this into a concrete allocation. If I were deploying $100 today, here is exactly how I would split it. $30 into NVIDIA. It is the anchor of this portfolio. Highest revenue certainty, deepest backlog, it earns the biggest slice. $20 into Amazon, because cloud growth, advertising revenue, custom silicon, and satellite broadband all under one balance sheet. $20 into Broadcom, equally weighted with Amazon because the conviction level is similar. $15 into Arista, smaller company with a faster growth rate, but it gets a smaller slice because the risk profile is slightly higher. $15 into Vertiv. Power demand from AI is structural, so same sizing as Arista because both carry similar upside to risk ratios. This portfolio covers both scenarios. If the Fed holds all year, NVIDIA, Broadcom, and Amazon carry it on AI demand. If cuts come in June, Arista and Vertiv add the torque on top. Either outcome is covered. Let me pull back for a moment and look at why this matters beyond just the March meeting. JP Morgan projects AI infrastructure capital expenditure will reach $1.4 trillion annually by 2030. BlackRock's Investment Institute expects $5 to $8 trillion in total AI-related capital expenditure through 2030. That spending does not pause because the Fed holds rates for one or two meetings. It is already committed. Data centers are under construction right now. GPU orders are already signed. The uncertainty I described earlier is real, but it is short-term. The long-term demand these 5 companies are being built to serve. The March meeting is a window, not a warning sign, and I am using it. I want to be clear. Nothing in this video is financial advice. Do your own research. Speak with a financial professional before making any investment decisions. Want to know more about Fed meetings? Click on "The Fed's next rate move could break